Hello, Michael Shotnik with Sierra Pacific Mortgage. Hope you're doing well. In this video, kind of chat about adjustable rate mortgages, also known as ARMs. So going to start high level and then dig into some fairly technical details. There's a lot of good info in here. However, if you have any questions, need any additional information, feel free to reach out. So ultimately an ARM is a mortgage with a fixed rate for a specific period of time, and then after that specific amount of time, the interest rate adjusts. There are some pros, and there are definitely some cons. So pros would be they generally have a lower interest rate depending on economic timing. They may be used to help a home buyer qualify for more home, which can be important in an environment like we're in right now where housing is expensive. It would allow a homeowner to take advantage of falling interest rates without refinancing, and a homeowner may be able to create monthly savings and either pay off debt, invest for retirement, so forth and so on. Some of the cons are definitely more complicated than, say, a fixed rate option. So a 30-year fix, kind of the default mortgage product. Really simple, the interest rate doesn't change over the 30-year term, whereas an ARM isn't quite as simple, which again, pros and cons associated with that. Another con, the payment can increase after the fixed period. And then another con would be, it may create some risk. So thinking back to kind of the 2008 to 2010 kind of recession, ARMs were a large culprit. ARMs these days are more responsibly provided by loan originators. However, they still do create risk where someone who's owns a home, has an adjustable rate mortgage, and let's say that the rate starts to adjust, they can't refinance out of it or sell the home. It can obviously create some risk. So who's a good fit for an ARM? And this is where I think an originator or loan officer would need to be very critical and give real good advice about if a particular client is a good fit for an ARM or maybe not. It really tends to favor that homeowner who is okay with a bit more of a dynamic mortgage product, which again isn't for everyone. Those, in addition to someone who's comfortable with a dynamic product that would maybe benefit from an ARM, would be a homeowner who doesn't plan to stay in their home long term, so they could benefit from a lower interest rate while they're there, and then potentially sell the home before that fixed rate period expires. Another example would be a homeowner who doesn't plan to have their mortgage very long. So that could be someone who's going into retirement. Once they get to, say, 62 years old, they'll transition into a reverse mortgage. And let's say that's 4 or 5 years out. They could benefit from, say, an ARM during that fixed period, and then after that period, take themselves out of the ARM and/or have a plan to pay off the mortgage. I think an overlying kind of theme here would be, an ARM is the best fit for a homeowner whose income is really stable, credit stable, so their ability to borrow there's confidence there. So that way, if they do get into a situation where they need to refinance out of that ARM, they have the capability to do so. Recently, in the news, you may have heard about kind of this inverted yield curve. It's a fairly technical term, but what that really means is when we're comparing short-term rates to long-term rates, generally we see a very kind of natural yield curve where the short-term rates offer better pricing than, say, the long-term rates. But when we invert that, that's exactly what that's referring to. So in recent years, we've seen where short-term rates were actually more expensive than long-term rates. So say an ARM product would actually have a higher rate than a 30-year fix. In those environments, ARMs just don't make sense. Taking on the security of a 30-year fix and at the same time getting a better interest rate makes a ton of sense. However, we're starting to see a little bit of a shift into an environment where short-term rates are better than long-term rates, not substantially so, but again, timing is important here. The Fed is generally in the background manipulating the market one way or another. So depending on their agenda, we'll see inverted yield curve, maybe a more natural yield curve where ARMs make sense. So timing is important. That's where it's worth at least considering the option. So now let's get into the specifics with ARMs. So previously, Libor was the index used to drive ARM pricing. However, it was determined that the Libor index was too volatile and it was manipulatable. So there were private individuals in there or institutions manipulating the Libor, which had a huge impact on the financial markets. So now the SOFR index is used, and that stands for Secured Overnight Financing Rate. It's intended to be a more accurate barometer of the market. The options available, and we're talking conventional financing, would be a 5-year ARM, a 7-year ARM, and a 10-year ARM. What that means is 5-year, it has a fixed period of 5 years, and then after that fixed period, it's subject to adjustment based on the SOFR index. 7-year, same thing, fixed for 7 years. After that 7-year period, it's subject to adjustment based on SOFR index activity. Same thing for the 10-year. ARMs are comprised of really 4 basic components. The index, which we talked about, is driven by SOFR. The margin, which is established by the lending institution and or the agency, so Fannie Mae, Freddie Mac. Interest rate cap. So let's say the interest rate's 4.5%, and it's a 5-year ARM. At the end of that 5-year period, there are limitations as to how much that interest rate can increase, depending on the term of the fixed period. So I'll speak more to that in just a little bit. And then the initial interest rate period. So again, that's that fixed period. All right, so let's get even more specific here. So the 5-year ARM, fixed for 5 years, after that adjusts every 6 months. 7-year, fixed for 7 years, adjusts every 6 months after. 10-year, fixed for 10 years, adjusts every 6 months after. So it's called a 5/6, 7/6, 10/6 ARM. The first interest rate change, or let's see, the caps, that's what I wanted to circle back to. On the 5-year ARM, the first adjustment may change the rate by no more than 2%. The 7 and 10-year ARM may change the rate by no more than 5%. So a bit of a difference there. In an environment like we're in now, I could see fixed rates being quite a bit higher potentially in the future. So with the 5-year ARM, there is a bit more protection. However, with the 7 and 10, obviously you get the longer fixed period. After that initial rate adjustment, each subsequent rate adjustment can not exceed 1% up or down. Lifetime cap on all of these is 5% greater than the starting interest rate. So again, if you start at 4.5%, and let's say that the index, the SOFR index, goes considerably higher than where you started, then you're looking at say a 9.5% cap on that, which really isn't a great position to be in. That's why going back to where we started, making sure that you can potentially refinance out of it is a good thing. Conventional ARMs are not convertible, meaning you cannot take it from an adjustable to a fixed note. And then they are assumable. This is kind of interesting. Once you're in that adjustable period, the loan is assumable, meaning if you sell your home, you can also transfer the financing to, say, an incoming buyer, assuming they qualify. When thinking in terms of leveraging an ARM to create more purchasing power, a 10 and a 7-year tend to be the way to go. When you look at a 10 and 7-year, you can qualify off of the note rate. On a 5-year, you qualify off of the note rate plus 2%. So let's say a 5-year was at 4.5%. You'd have to qualify at 6.5%, so that counterproductive there. A 7 and a 10, you'd be looking at qualifying at, say, that 4.5%. So when thinking in terms of strategy, making the home more affordable, on paper anyway, from the outset, 7 and 10 could be the way to go. So a lot to consider in there. Could be a very, very worthwhile side-by-side consideration if you're considering a refinance or if you're considering a home purchase. Feel free to reach out. Happy to help you think through that and give a bit of feedback.